So Robinhood likes to think of itself as the character on the left. I like to think of it a little more as the character on the right. So in my view, apps and platforms like Robinhood are really taking advantage of what they know about human psychology. And they profit by something called payment for order flow, which if you've heard of it, it's often talked about in a kind of evil and demonizing light. If you read the book Flash Boys, it really paints a very negative picture of high frequency trading firms as just sort of skimming money off the top of every trade. That's not my view. I think payment for order flow itself as a practice isn't necessarily corrupting, but what it does do is incentivize Robinhood to pump up volume as much as possible. So if they make a tiny sliver of an amount on every single trade that happens, they're going to make more money if there's 100 trades than if there's 50 trades. They don't care if those are good trades or not. They don't care if their users are losing money on those trades or making poor financial decisions. They just want to jack up the number of trades happening. They want to be the middleman of as many deals as possible, regardless of whether those deals are good ones. So Jordan Dilts did some research prior to sort of the electronification of retail trading. So prior to Robinhood as an app existing or widespread access to lots of financial products on people's laptops. And even then they found that only 20% of day traders or retail traders are marginally profitable. So only 20% of them actually make money if they're involved in sort of playing with the stock market. I can only guess that that number would be made worse by having less information on an app. And Robinhood stopped publishing this data, which is personally frustrating to me. But if you look at sort of the top traded stocks on Robinhood, the ones that are traded on the most by their users, the top 0.5% of those stocks, so the most popular stocks on those apps, lose 5% of their value over the next month. And if you look at the top 0.1%, the most popular stocks on Robinhood, they lose almost 20% over the next month. And that might sound kind of strange, but that's really common in what we would want to call momentum trades, right? If you have a herd of sheep following a price super far up, lots of people go, oh my goodness, that's far too high of a price for that kind of stock. You see some shorting and the price of that stock goes back down. So that's how you could explain things like that. And that research, sorry, is from Barber et al. In 2020.